Now, starting with the idea of capital. Now, every bank requires capital. Rather, I would say every business will require capital because capital is something which will decide how exactly a bank is going to grow over time. So, not just growth, but so growth is definitely one. But along with growth, capital is something which will also define the stability for a bank or a lending institution. So naturally, a bank which has a very robust capital base will see they will have a very robust balance sheet as well. So that's why the market is going to view that bank to be like a safe bet or a safe investment. So naturally, the interest in that bank is going to increase. So that way, the bank will be able to attract more and more customers, and its business is expected to grow. At the same time, whenever they have an ample amount of capital on board, that is something which can be applied for pursuing different business lines because every bank is evolves over a period of time. So yes, the traditional business model will continue. However, there are always new products and services which any bank would like to pursue. So at that time, again, the idea of capital comes in, and that's why capital management for banks becomes very, very important. Now, let's begin with some basic differentiation between a cash capital and a risk capital. And then we'll spend more time on the risk capital side of things. Now, what do we mean by cash capital? This is defined as the amount of capital which a bank will require for conducting its day-to-day operations. So we can think of cash capital as something which will satisfy the working capital requirements for a bank. Whereas a risk capital, this is something which is of interest to us. Now, this is something which will be used for absorbing any kind of losses which the bank is going to be exposed to. And bank will be exposed to losses because we know the core business model of the bank is lending. So whenever there is any kind of lending operation which comes in, there is always a certain risk which is associated with that. And a risk capital is something which will be used for absorbing those kind of losses. Now, here we have shown a very simple diagram for risk capital. And if you observe, there are different sections which are nomenclature from A through to F. And the description of these sections has been given here. So from this, you may guess that the order in which the sections have been arranged is generally the order which you'll observe from the point of view of loss absorption. So our readers are familiar with capital structure theory. So even we know that in capital structure, equity holders are the first ones who absorb losses, right? So equity holders, then come the debt holders, and finally you have the depositors who are then exposed to losses. So we have also shown this in a similar way. So that way the loss absorption is going to trickle down from section A through to section F. Now these sections have been mentioned here. And this section below, starting from the 0 up till the section F, is what we call as a risk capital. If you observe, we have also plotted the returns and expected losses, and from that we have depicted the idea of risk capital. Now focusing on the risk capital idea, because that is what is of interest to us. Now, every bank is going to require funds to continue its operations, right? So that's why you see banks are so aggressive when it comes to attracting customer money or stakeholder money, I would say. So whenever stakeholders park cash with the bank, that is something which the bank is going to use for running its core business operations. So if you want to look at this in some other way, or looking at definition the other way, we can also say that the stakeholders are selling insurance to bank in the form of assets. Now, shareholders and bondholders or debt holders, they sell majority of the insurance. Now, bondholders can be a mix. So you can have junior debt and senior debt, because as we know, as a part of capital structure, even for the debt portion of things, you could have bonds with different seniorities which are there. So depending on that, we'll have different classes of debt holders, both junior and senior, something which we have shown here as well, if you observe for section C and D. Now, depositors sell little or almost no insurance from this perspective. So risk capital can broadly be viewed as a premium required by banks to purchase this insurance from their stakeholders. Now, this is the capital structure or the capital structure theory point which I had mentioned earlier. So it's the equity holders who are going to absorb the first incoming losses. Subsequently, it is the junior bondholders or junior debt holders, then come the senior debt holders, and finally come the depositors. So this is the exact same order which has been shown on the earlier chart as well. So that's how the losses are going to trickle down as well. Also, equity capital is also called as a going concern capital, and a debt capital is considered like a gone concern capital. So this is also kind of a nomenclature which you'll see in many books which talks about bank capital. So we thought making a mention of this would be useful for connecting with those references later on. Now, if we look at the chart above, we have shown a section which talks of risk capital, right? So we may be tempted to say that risk capital should be able to absorb all of the losses which are a result of the bank doing its business. Now, the thing is, yes, I mean, risk capital will be used to absorb losses, but it won't be very efficient to allocate the risk capital for every single kind of risk which the bank is taking, because we also need to understand the business or strategic risk which every bank or a lending institution is taking. So for this purpose, we need to introduce one idea which we call as an economic capital. So you have an economic capital and a regulatory capital, as we'll see. We'll also understand how the calculations work and what's the main difference between them. So what is economic capital? So economic capital is something which will be driven by the business of the bank. So every bank and its senior management, so including board of directors and senior managers, the CEO, etc., each of them will be taking part in discussions as to what is the kind of risk or maybe what is the kind of strategy which the bank wants to pursue. And based on that, they'll want to develop an internal model. Now, bank can either develop model internally or they could hire experts in order to build such a model for them. And these kind of internal models will be used to estimate the amount of capital which will need to be allocated as a form of economic capital. And the idea behind this is the economic capital is something which will come to rescue whenever there is any kind of systemic or a market stress which is to build up. So the idea is bank should be sufficiently capitalized, and even if its business does come under stress because of the changing market conditions, still the bank should be able to tide over those things. So for that purpose, economic capital becomes very, very important. We will discuss more things on economic capital in a bit. Regulatory capital. Now, this is something which will be defined by the respective regulators. So a regulator in every jurisdiction defines the guidelines which every bank in under their purview need to abide by, and this is also what we call as minimum capital requirement for banks. And regulatory capital is something which the bank needs to maintain at all times. Now, there are no two ways about it. If the bank is unable to maintain the regulatory capital, the regulator can immediately start disciplinary action against the bank, and no bank wants to be on that side of things.